Welcome back. In this session, I will be introducing you to how you recognize an accounting items. When we talk about financial statement, we're referring to three types of them. Statement of financial position contains assets, liabilities, and equities. They're producing as the last day of the financial year. Statement of profit, loss, and other comprehensive income contains information about income and expenses. It usually produced to cover the last year financial performance. It also contains information about changes in the current value of an asset and liability. Other statements would including like cash flow, which we will look into it in the later of the courses. All of the financial statements are created based on an assumption that the business will continue to operate in the next year. So it is built on a going concern principle. There are 5 elements of the financial statement: asset, liability, equity, income, and expenses. Asset means the present economic resources controlled by the entity as a result of past event. Liability refers to the present obligation of the entity to transfer an economic resource as a result of past event. Equity is the difference between the asset and liability. Income, it refers to the increase in asset or decrease in a liability, where expense refers to the decrease in asset or increase in liability. So you would actually see the asset and liability are the very fundamental basic concept to consist the other 3 of them. The Conceptual Framework 2018 have made significant changes in the definition of asset and liability. The previous version of an asset refers to a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. So key terms here: controlled, result of past event, and future economic benefits. In a new definition, it has 2 parts. It first defines that the asset is a present economic resources. It is being controlled as a result of past event. And it's give a definition of what it means by economic resources. So in the previous version of the definition, it does not actually give you an idea what it means by resource. And they tend to understand resource as the physical things that we actually would be own. But in this new definition, the economic resource is defined as a right that has the potential to produce economic benefit. So this means that if you have access to a certain machine and use it to generate some products, even though that you do not necessarily own this machine, you probably still have to recognize it as your asset, because that constitutes as your economic resource, that right to access to that machine and use it to produce free product. Let's look at liability. The previous version of liability is defined as a present obligation and as a result of past event, and the settlement of which is expected to result in outflow from the entity of the resource embodying economic benefits. So the new definition again is inconsistent with the idea of assets. So it also has 2 parts, just like asset. The first part defines what is a liability. It's a present obligation, that's the same, to transfer an economic resource as a result past event. So we have learned economic resources from the idea of assets. It means a right that has the potential to produce economic benefit. So in this way, it means that the business would have certain obligation to transfer a right that has the potential to produce economic benefit. And the obligation would mean it's a duty or responsibility that the entity has no practical ability to avoid. I would like you to take a pause in this slide and consider about following items. How would you account for them? The company's head office, the furniture in that office, a painting that hangs in the boardroom, cars rented from a leasing company, stock for sale, stocks obtained on a sell or return basis, cash in the bank, a bank overdraft. So how would you consider those items? Are they meeting the definition of asset or they're meeting the definition of liability? Stop the slides, have a think, and before you proceed. In this slides, again, furthermore questions is how would you account for those things that has a value? For example, there's a rusty metal worth £10 as a scrap, but costing £20 to transport to the scrap dealer. So how would you recognize? Would you recognize value at 10 or recognize at a costing of 20? Would you recognize the skilled workforce employed by the entity? There's a legal claim arising from the allegation that entity has sold defective products. So how would the entity would be able to account for this legal claim? Do they need to recognize that as a future obligation or a present obligation? Again, the last one, the purchasing order for a new machine that costing 100,000. How would the business recognize this one? You may want to stop the slides and try a bit about the double entry and see what you're going to put in the debit and what you're going to put in the credit and have a try. If there's something that satisfies the definition, does it need to be on the statement of financial position? And the answer to that is not necessarily. It also must meet the definition of recognition. So the recognition is the process of capturing items that meets the definition of an element in the statement of financial position or the statement of financial performance. Previously, it was a three-step decision. The first, it needs to meet the definition of an element, and the second, it needs to be probable that any future economic benefit associated with flow to or from the entity, and third, the items has a cost that can be measured reliably. The renewed revision of the recognition means that the recognition is appropriate if it results in both relevant information and also faithful representation of those items. So the revised recognition definition is now being connected with the fundamental characteristics of information that we have discussed earlier. And if we look at the relevance and faithful representation, and we know that the relevance sometimes would be affected by probability. So if there is a low probability of a flow of economic benefits, where there's a huge uncertainty for it to exist, it's likely that you would recognize that as irrelevant and you will not recognize the item, even if it meets the definition. Faithful representation would sometimes be affected by the measurement uncertainty. So whether we can actually give a value to it or we can approach it with some plausible approach that gives you some kind of figure. So at each financial year, at the very beginning, you would have an open balance. And in your statement of financial position, you will have your open balance of your asset, liability, as well as your equity. And during the year, the asset would change its value. The liability would also have changes, so as the equity. And then you recognize them either into income or expenses. And at the end of the year, what you would get, you would have a closing balance of your asset, liability, and equity.